There's lots of differences between these banks. And that's the first thing people will think when they hear I was talking about like Metro Bank and Norinchukin in the same sentence. They're very different animals. Metro is tiny, Norinchukin is massive. They focus on different things. However, what they have in common is that they are small relative to their domestic markets. So they don't tend to have the same level of oversight from regulators and supervisors as the larger banks. That means that things can go wrong and they're not really caught as quickly. Generally speaking, then, these kind of regional banks, specialist banks, localist banks, they also tend to have a higher risk when interest rates change quickly because they tend to not have hedged as much as some of the larger banks would have done. They also tend to be more vulnerable in fragile economies because they tend to be a pure play on whatever economy their main market is, be that the local economy from a part of Germany, be that the shipping market, or be that in this case the commercial real estate market. A lot of them are big in commercial real estate. Commercial real estate, as our regular listeners know, has gone through a lot of stresses and strains recently. It's one of these ones where it's a bit like the dangers in the private credit market, where it's something that regulators are attuned to, but just because they know there's a big world out there where there could be issues doesn't mean they necessarily have the tools and have the ability to actually tackle those. So trying to understand the diverse risks across, and we're talking about thousands of banks right across the world, is really genuinely very difficult. It's much easier to supervise one massive bank than it is to effectively supervise thousands of very small entities. So I think they are attuned to the fact that there are risks there. They know that even though these institutions are individually small, they are collectively large. They often fail as a herd. So they are attuned that there are big risks there. The challenge is trying to actually find the needle in a haystack of where these risks are going to actually blow up. Because if you ask regulators at a kind of global level what SVB was like 5 years ago, a lot of them would have been going, huh?
Does this entail, just briefly then, Laura? This is governments then needing to this is governments needing to retool regulators and give them what the equipment they need, the skills they need, and the enforcement measures they need to get on top of this. Is that where the debate is heading at this point, or is it more of a case of monitoring and then reacting?
There is an element to that, but yeah, as you say, the first thing is actually trying to do better surveillance, trying to understand where those risks are, and then trying to think about the way to mitigate those risks. But what I will say is, as your listeners also know, most of the mood music at political level is in favour of less regulation and more growth. So I think there's certainly a knowledge among those in the financial stability world that we need to tackle this, but like politically, we're talking about taking away regulation rather than increasing it.